Hello, everyone, and thank you for joining us today for this Haynes International, Inc. fourth quarter fiscal 2020 financial results conference call. As a reminder, all phone lines are in a listen-only mode, but after today's prepared remarks, you will have the opportunity to ask questions. To get us started today with opening remarks and introductions, I am pleased to yield the floor to Controller and Chief Accounting Officer, Mr. David Van Bibber. Good morning, sir.
Conference call contains statements that are forward-looking within the meaning of the Private Securities Litigation and Reform Act of 1995 and Section 21E of the Securities and Exchange Act of 1934. The words believe, anticipate, plan, and similar expressions are intended to identify forward-looking statements. Although we believe our plans, intentions, and expectations regarding or suggested by such forward-looking statements are reasonable, such statements are subject to a number of risks and uncertainties, and we can provide no assurances such plans, intentions, or expectations will be achieved. Many of these risks are discussed in detail in the company's filings with the Securities and Exchange Commission, in particular Form 10-K for the fiscal year ended September 30th, 2020. The company undertakes no obligation to publicly update or revise any forward-looking statements, whether as a result of new information, future events, or otherwise. With that, let me turn the call over to Mike.
Thanks, Dave. Good morning, everyone. As our team leads our company through the impact of the pandemic, I thought I would start this call by highlighting some of the positives from this past quarter. While this has been a difficult period, we have executed well, and I'm proud of our team's accomplishments. First, starting in late March, we prioritized cash generation. After generating $13.1 million in cash in our third quarter, we generated an additional $11.7 million in Q4, for a total of $24.8 million in the second half of our fiscal year. We have also developed plans for positive cash generation to continue throughout fiscal 21. Next, we have strong liquidity, no debt, and $47.2 million in cash on our balance sheet. Due to our high level of confidence in operating cash in fiscal 21, we paid off the $30 million precautionary draw on our revolver in September 2020. Many years of tightly managing our balance sheet have set us up well to manage our way through the pandemic. In addition, our team is strategically positioning our company to exit this downturn with a competitive advantage by leveraging our mill direct and service center routes to market. We are building flexible intermediate inventory in the mill to allow for consistently shorter lead times in the future for our high-volume alloys, while our service centers are targeting stock for even shorter lead time requirements and smaller order quantities. We also plan to continue to invest in value-added cutting capacity to provide high-value differentiated products and therefore build additional competitive advantage. Throughout this pandemic, we have stayed in close contact with our customers, continuing to provide what they need when they need it, and to gain their insight into current business conditions and future demand requirements. Next, we are pursuing market share gains and have moved from talking about it to achieving it in our industrial gas turbine market segment, where we began shipping increased volume to a new customer in Q4. In addition, we continue to focus on our value-based pricing for our high-value differentiated products, while at the same time seeking to be competitive on the commodity alloy portion of our CPI mix in order to drive volume. Our average selling price, both sequentially and year on year, has held up well despite the drop in volume. Our entire team continues to emphasize the value that we provide via our unique proprietary alloys, our quality, our technical and sales service, and our just-in-time inventory. Next, we reacted swiftly after the pandemic began in the U.S. to take costs out of the organization with salary reductions, unpaid furloughs, headcount reductions, and other actions to reduce our costs as we've managed through the pandemic. While it's difficult to reduce costs in full proportion to our volume reductions because of the many of our costs are fixed, we analyze all discretionary spending and made very difficult but necessary decisions. Although the work on SG&A and volume-related cost reductions is very important, also important for the long-term health of our business is the ongoing work to improve yields and lower manufacturing costs. Our cost and yield initiatives in Q4 are expected to further benefit us as our volume comes back. After the pandemic, these actions should keep us on track to improve our gross margin percent, which reached 18% in the 2 months prior to the pandemic. In addition, sequentially, our gross margin improved in the fourth quarter compared to the third quarter, going from 3.3% to 4.9% in spite of volume and revenue declining. This shows our ongoing commitment to reducing costs in this low volume environment. Dan will have additional details on this in his financial update. A couple more positives. Our alloy and application work continue to provide high-value opportunities for us in unique applications. We're currently working on opportunities involving both new alloys and new applications for existing alloys. I continue to believe that innovation is a core strength for our company and the foundation of Haynes. Our safety rate has continued to improve throughout the year. Our process improvement initiatives keep safety front of mind for everyone in our company. I'd like to take a moment to congratulate our Arcadia, Louisiana 2 facility, which completed a full year without a recordable incident in September. I'm very proud of our team. This has been a difficult 8 months for everybody. We've continued to effectively focus on the health and safety of our team while also dealing with the significant business implications of the virus. Our team has continued to show focus, determination, and leadership. Now, a few final summary comments from me on revenue cost reduction and cash generation before I hand it over to Dan. Our very low business levels in the second half of 2020, fiscal 2020, were challenging and resulted in an unprecedented step down in revenue levels. We continue to monitor the respective markets and look for favorable signs of the recovery. I'll point out that our order entry has begun to improve and move in the right direction from the very low levels we saw in May and June to a slightly higher level in Q4. While we have a long way to go, it is certainly a step in the right direction. On the cost and margin side, our past price and variable cost work led to significant gains in year-on-year gross margin percent in Q1 and Q2, and a reduction in our break-even point from the much talked about 5 million pounds per quarter to less than 4 million pounds a quarter. Our January and February gross margins of 18% show what we are capable of. However, with our Q4 sales volume being just 2.9 million pounds, we are incurring losses, the majority of which can be attributed to the unfavorable fixed cost absorption resulting in direct charges. In addition to the significant reductions in pounds sold from lower demand, we also reduced inventory levels by another 1.1 million pounds in the fourth quarter. This combination of lower sales levels and inventory reduction led to a sizable reduction in pounds produced in our Kokomo mill in the fourth quarter. That reduction was 49% year on year. We simply cannot spread the fixed costs we have over 50% less produced pounds. As discussed, we have successfully increased our cash balance since we pivoted to a cash generation focus as the pandemic began to impact all of us. I like to talk about the fact that our inventory reductions were done responsibly, meaning that we have our customers' needs as our priority even as we reduce inventory. As an example, despite reducing inventory by 2.8 million pounds in Q3 and Q4 combined, we actually built a modest amount of strategic work in process inventory in our high volume alloys, allowing for lead time to be reduced to more quickly support our customers when business levels do improve. I'll now turn it over to Dan, who will provide more details on our specific markets and on our financial results.
Thank you, Mike. Let me start with a look back at our quarterly volumes. At the end of last year, fiscal 2019, our fourth quarter volume was 5.4 million pounds, which was the company's highest quarterly volume in 4.5 years. Moving into fiscal year 20, the first half was impacted by the grounding and production halt of the Boeing 737 MAX, lowering aerospace volumes, combined with weak oil prices, which lowered volumes in our chemical processing market. Volumes in the first and second quarters were 4.2 million and 4.3 million pounds, respectively. The second half of fiscal 20 was then significantly impacted by the COVID-19 global pandemic, which lowered volumes in Q3 and Q4 to 3.2 million pounds and 2.9 million pounds, respectively. The fourth quarter volume of 2.9 million pounds represents a 46% reduction from the 5.4 million pounds in last year's fourth quarter. Net sales in the fourth quarter of fiscal 20 was $79.9 million. Looking at each of our major markets for the fourth quarter, sales to the aerospace market accounted for 42% of our revenue at $33.6 million. This is a decrease of roughly 17% sequentially from Q3 and a decrease of 51% from the same period last year. The pandemic has had significant effects across the aerospace industry, with announced reductions in commercial aerospace build schedules, combined with reductions in repair, maintenance, and overhaul activity. Complicating the demand situation continues to be the elevated amount of inventory throughout the aerospace supply chain. Destocking is expected to continue in fiscal year 20. Backlog dollars in aerospace decreased sequentially from Q3 to Q4 by 16% and down 46% year over year. Fourth quarter sales to the chemical processing market accounted for 23% of our revenue at $18.5 million. This is an increase of 52% sequentially from Q3, but a decrease of 33% from the same period last year. The sequential increase from a very low level relates to a pickup of shipments into Asia. It is also reflective of our approach to seek higher volumes from commodity CPI transactional business with more competitive pricing. This market will continue to be impacted by COVID-19 and an environment of low oil prices causing chemical companies to delay their CapEx spending. Backlog dollars and CPI were flat sequentially from Q3 to Q4, but down 13% year over year. Fourth quarter sales into the industrial gas turbine market accounted for 16% of our revenue at $12.4 million. This is a decrease of 9% sequentially from Q3 and a decrease of 21% from the same period last year. Shipments into this market can be lumpy quarter to quarter. The decrease is attributable to conservative purchasing methods due to COVID-19, combined with small and medium frame engine builds slowing down due to the weakness in the oil industry. Our share gain initiative continues. However, given the current economic conditions, the shipments are not yet consistent quarter to quarter. Backlog dollars in industrial gas turbines decreased sequentially from Q3 to Q4 by 15%, however, are up 11% year over year. Fourth quarter sales in other markets accounted for 12% of our revenue at $9.2 million. This is a decrease of 17% sequentially from Q3 and a decrease of 16% from the same period last year. Again, demand was impacted from the effects of the COVID-19 pandemic. Decreases were largest in the flue gas desulfurization, automotive, and oil and gas markets. Backlog dollars in other markets increased slightly from Q3 to Q4 by 2% and 1% year over year. Fourth quarter other revenue accounted for 18% of our revenue at $6.2 million. This is a solid increase of 94% sequentially from Q3, but a decrease of 8% from the same period last year. Solid toll conversion sales drove the sequential increase, both on our 4-high rolling mill, but also conversion work in our melt shop. Overall, fourth quarter volume was 2.9 million pounds. While this low volume compressed gross margin significantly this quarter, the compression alleviated somewhat from the third quarter by 160 basis points. Gross margin in the fourth quarter was 4.9%, compared sequentially to the third quarter's 3.3%. This margin expansion occurred even though volumes declined. The amount of fixed overhead costs that we charge directly to cost of goods sold as opposed to capitalizing into inventory as our plant capacity was underutilized decreased this quarter compared sequentially to last quarter. Last quarter's direct charge was $5.9 million in Q3, but favorably declined in Q4 to $4 million. We are continually and diligently striving to reduce our costs to better align our cost structure to these new lower volume levels. This quarter was also challenged with heavy costs in three different categories. First, increases in inventory reserves of $1.5 million, which is about $500,000 higher than Q3 and about $1.1 million higher than last year's fourth quarter. Second, costs roughly $250,000 to $300,000 of COVID-related costs, such as for staggered shifts, quarantine pay, cleaning tasks, and cleaning supplies. And third, additional severance-related cost of approximately $300,000 in the fourth quarter. In total, we have reduced headcount by roughly 183 as of October 31st, 2020, or 15% of our global workforce. This equates to approximately $14 million in annualized salaries, wages, and fringes. In addition, during the fourth quarter, the executive team and the board of directors continued their 10% pay reduction, and salaried employees continued their 1-week unpaid furloughs. SG&A, including research and technical expense, was $9.1 million in the fourth quarter. SG&A was reduced this quarter due to the reversal of incentive compensation accruals of $1.2 million, which was accrued in prior quarters but fully reversed in the fourth quarter. Excluding this reduction, SG&A was $10.3 million as compared to last year's fourth quarter of $12.5 million, or a reduction of 18%. Three additional points to finish out the P&L. First, non-operating retirement benefit expense on the P&L was $1.7 million, which nearly doubled compared to last year's numbers, as we had talked about previously. Though we have some good news for fiscal 21. In a moment, I will further discuss our new valuation and next year's expense. The second item to finish out the P&L, interest expense in the fourth quarter, was slightly lower as we repaid the precautionary draw on the revolver, which occurred mid-March. And third, our effective tax rate was adjusted lower this quarter to 21.2% as we finalized our year-end tax provision. All of that resulted in a net loss for the quarter of $5.7 million, which sequentially improved by $2.4 million. Let me circle back to the topic of our recent valuation at September 30th, 2020 of our pension and retiree medical plans. The actuarial valuation was favorable. Although the valuation included a reduction of the discount rate used to measure the plan liabilities, which is unfavorable, it was offset by favorable items including higher than expected return on plan assets for the pension plan and favorable retiree health care spending, as we have been actively managing our retiree health care costs. This is expected to significantly reduce non-cash expense in fiscal 21 by $2.2 million for the pension plan and $3.4 million for the retiree health care plan. This combined $5.6 million will be reflected primarily as a reduction of non-operating retirement benefit expense in the P&L in FY21. Moving to backlog, while we have experienced low order entry levels primarily due to the pandemic, order entry rates slightly increased in the fourth quarter of fiscal 20 compared to the third quarter, but still below shipment rates. Backlog was $153.3 million at September 30th, 2020, a decrease of $21.3 million or 12% from the $174.6 million at June 30th. For the full fiscal year, backlog decreased $81.9 million or 35% from the $235.2 million at September 30th, 2019. Capital spending was $9.4 million in fiscal 20, and the forecast for capital spending in fiscal 21 is $10 million, which continues to represent a level well below our depreciation levels. Liquidity. The company had cash of $47.2 million and zero borrowings against the credit facility as of September 30th, 2020. The company repaid the $30 million precautionary draw on the revolver in September, due in part to generating $24.8 million in cash in the last 6 months of the fiscal year, primarily from inventory reductions, and the company's confidence in its ability to generate future cash and its overall liquidity position. In addition, subsequent to year-end, in October of 2020, the company replaced the $120 million credit facility set to expire in July of 21 with a new $100 million credit facility expiring in 3 years. The new credit facility contains an accordion feature that permits an increase up to $170 million at the request of the borrower if certain conditions are met. You can find the details of our new credit facility in our filings with the SEC. Outlook for next quarter. We continue to experience market uncertainty driven by the COVID-19 global pandemic. We expect revenue in the first quarter of fiscal 21 to be lower than the fourth quarter of fiscal 20 due to the ongoing impact of the pandemic, as well as the typical end-of-year holiday-related business slowdown, maintenance schedules, and customers managing their calendar year-end balance sheets. Earnings for the first quarter cannot be estimated during this time of unprecedented market and economic conditions, low volumes, and unfavorable fixed cost absorption. We expect to continue to generate cash from inventory reduction in fiscal 21, and we continue to position the company favorably for the recovery. In conclusion, looking forward, we continue to see significant demand challenges ahead. Despite these challenges, we continue to feel that we are well positioned to weather this period driven by our ongoing efforts to align our cost structure and inventory levels to current demand levels. With inventory levels at $246 million at September 30th, 2020, which is 65% of FY20 sales, we believe additional inventory reduction is achievable. This strategy is expected to yield an increasing cash balance over fiscal year 2021. Mike, with that, I will now turn the discussion back over to you.
Thanks, Dan. This has been a stressful time, obviously for the world, our country, our families, and our businesses. I again want to thank our employees. They all continue to push forward, initially to protect the health of our employees, and obviously that's ongoing, and then to jointly lead Haynes through these turbulent times by pivoting to cash generation, focusing on what differentiates us from the competition, and implementing the actions required related to our key metrics for success. With that, Jim, let's open the call for questions.
Gentlemen, thank you. And to our audience joining today, if you would like to ask a live question at this time, simply press star and 1 on your telephone keypad. Pressing star and 1 will place your line into a queue, and I will open the lines one at a time. Also, a friendly reminder that if you're joining us today on a speakerphone, please return to your handset prior to pressing star and 1 to be certain that your signal does reach our equipment. Once again, ladies and gentlemen, that is star and 1 if you would like to ask a question. We'll hear first from Steve O'Hara with Sidoti.
Hi, good morning.
Morning, Steve.
Morning.
Thanks for taking the question. I guess, if you look at, you mentioned the inventory levels and where they are right now in the channel. Can you just talk about, have they improved at all, or are they still kind of high? Do you need kind of a real pickup in demand for that to improve, or are things kind of maybe, progressing where inventories are getting cleaned up a little bit, here and there as we progress?
Okay, Steve, sure. We obviously spent a lot of time talking about this both internally and getting insight from our customers. We believe that inventory reductions throughout the supply chain are going to go on for another few quarters. Said another way, based on a lot of customer feedback, there's still probably 6 to 12 months of inventory in many areas of the supply chain. Obviously, there's going to be exceptions to this. We're seeing some exceptions, so we could see a modest uptick in 21, but that'll just be the first step, in our opinion, to the recovery. Our view, and I really think a great way to look at this, is to look at the LEAP engine, because I think what happens with the LEAP engines tells us what's going to happen with the aerospace industry. You all know the story. 1,736 engines in 19, initial forecast of 2,320, down to 800 this year, and somewhere between 800 and 1,000 next year. So what we're still dealing with is inventory in the supply chain to make over 2,300 engines initially projected in 2020, and that dropped to 800. So still inventory out there. The good news for us, projections are for the leap back to over 2,000 years. People start flying again starting in 2023, meaning that we believe the supply chains will be cleaned out and metal will start to flow in large quantities to support this late 21, early 22. Make sense?
Yeah, no, that's very helpful. Thank you. And then maybe just on the cost cuts, I think you mentioned kind of a $14 million annualized cost savings. Is that something that is kind of a true pickup starting in 2021? And maybe, how much of that kind of is incremental in 21 maybe? And then is the $5.6 million that you mentioned, I think on the pension, is that included in that $14 million?
Okay, I'll let Dan address the pension after I talk about the costs. I think when we look at costs, you got to look at it from 3 points of view. First is the SG&A and salary cost reduction that we went through. Those obviously were very difficult to implement. Not something that any of us looked forward to, but they're certainly there and will move throughout our upcoming fiscal year. At some point, obviously, when business returns, you're going to have to bring some of that back, but given the pain we went through to get to these levels, it'll take some time. On the variable cost side, there's really a couple ways to look at this. First, what we have done to get to our high point pre-pandemic of 18% was not only price increase, but significant variable cost reduction. And that work continues both on yield improvement and overall variable cost reduction. I'm very proud of those efforts. One of the things that happens, though, if you've reduced cost on a per pound basis, you don't get as much cost reduction with 2.9 million pounds as you did with 5.4 million pounds, obviously, so that hurts. So as we move forward, some of our past cost reduction is muted until our volume comes back, but also on the variable side, we continue to focus in all of our facilities in driving costs down. Dan, you want to cover the 5.6 million Steve asked about?
Sure. Yeah. The pension reduction and the retiree health care reduction really is not part of that 14 million that I referenced. That was only related to the permanent reductions that had occurred over the course. That occurred somewhat mostly in 2020. A little bit spilled into 2021 because I mentioned to you the October number, but that was majority of that number has already been realized in some of the numbers we're seeing for the fourth quarter and even a little bit in the third quarter of FY20, but unrelated to the pension. And I will say this too, it's also unrelated to other cost reduction measures that we've taken, like the unpaid furloughs is not part of that 14 million number. The 10% reduction in the executive staff salaries is not part of that as well. That's just one piece of a bigger cost reduction strategy. Does that help?
Yes, very, very helpful. Thank you. And then maybe last one, you noted CPI remains, I think, kind of low, given the economy, et cetera. What are the biggest markets there? I mean, it seems like, home building tends to be one of the bigger drivers of chemical, and then, auto seems to be the other big one. Are there other markets that, we should think about in terms of, getting that market back to, maybe improvement other than just general GDP?
Yeah, the oil prices have a significant impact. So when oil prices are down, there's less spending in the CPI market. So that's significant. Large pipeline projects are not out there. In general, we are seeing many chemical processing projects on hold, specifically related to COVID and everyone being a bit conservative with their spending. So that's one side. The other side is our special project side of things. We actually finished our fiscal year 20 in a pretty good spot related to year on year, staying plus or minus about even on our revenues on CPI. We're actually going to, on special projects within CPI, we'll see that drop somewhat because there's very few projects being let. But I would say, in addition to what you said, it's oil price, it's large pipeline projects in general, and it's our special projects.
Okay, thank you very much. I'll jump back into you, Steve.
Our next question will come from Chris Olin at Tier 4 Research.
Hey, good morning.
Hey, Chris.
Morning, Chris.
Hey, Mike, you referred to order rate improvements, although they were from a low level. I was curious if there was a specific end market that was driving that, or was it a broad-based improvement?
Yeah, let me get some facts here, Chris. The best way that I like to look at this is our book-to-bill, and it's kind of interesting when you look at pounds on what we book versus what we bill. In Q1, obviously pre-pandemic, it was at 1.0. I'll get to the markets in a second. Q2 was 0.7, Q3 was 0.6, Q4 bounced back a little, which obviously gives us some hope. It was at 0.9. And to specifically answer your question on the book-to-bill, Aero was still down. It was at 0.7 book-to-bill for the quarter, but CPI was slightly over 1. IGT was slightly under 1, and other was over 1. So Aero is lagging, as we would expect, as we talked about with inventory, but the others are coming back again. We've got a long way to go. We say we're in the road to recovery, but it's from very low levels, Chris.
Interesting. Okay. And then just want to make sure I understood what you said there on the special project pipeline or revenues. What was the actual number? I wasn't sure I caught that. And then I was just curious, did you talk about the pipeline, like any prospects in terms of what it could look like for the next fiscal year?
Yeah, the special projects were approximately $25 million in fiscal 19. We're probably plus or minus $1 million over that in fiscal year 20, because the lead times on these very complex products are very long. So a lot of what we had in there was things that had been ordered before the pandemic hit us. I'd expect a drop in our current fiscal year. Don't know the level of that. We have some numbers, but we're always pushing for more. So I would say year on year that's going to be down. But what we like is where the margin is and what's coming in. It's been a fairly rich mix over the past year, plus or minus. Dan, anything you want to add to that?
No, I think you nailed it. Just give you a specific number. In FY20, special projects, $26.3 million, where in FY19, $25.5 million. So you were right on in your numbers, Mike.
See that, Chris? I'm generalizing, and Dan comes and cleans it up, gives the actual numbers. Thank you, Dan.
Perfect. You guys have done a great job on the cost reduction side. I'm just trying to think about the normalization of volumes when we start looking out to like 22 and such. When you think about the 183 positions that were removed, would a lot of those jobs need to come back to increase production, or is there a way to think about how much of the cost reductions would stick going forward?
I think it was obviously very painful to remove people both on the production side and through the salaried side of our business. I think it was also fairly expensive for our company to do that. So certainly as volume comes back, there will be a lag, but there will be a need to bring back some of our production workforce in our facilities, but we will do that very slowly. And on the salaried side, we're going to have to be very careful after spending money to have to remove them to bring them back. Certainly, there will be some that have to come back, but it will be a very slow process to bring them back.
Okay, thanks a lot.
Thank you, Chris.
Once again, ladies and gentlemen, if you would like to ask a question or need clarification on anything covered in today's call, please press star and 1 on your telephone keypad. Next, we'll hear from Michael Leshock at KeyBank. Please go ahead.
Hey, Mike and Dan. Good morning.
Morning, Michael.
Good morning.
So first, just on your internal inventory destocking, I know you said you're looking to destock more inventory into 2022, but looking at the fiscal 1Q, how should we expect the magnitude of the destock to be versus the sequential change that we saw this quarter?
We've seen, in the second half of last year, we aggressively removed about 2.8 million pounds of inventory. This is a real balancing act for us because We have to keep some metal flowing through our plant. Obviously, our shipment level is not as high as it's been in the past. And Q1, by the way, is typically a tough quarter for us to reduce inventory. So I don't know, to be honest with you, the spread across the year, but we do expect to continue incrementally quarter after quarter to find ways to reduce inventory. Dan?
Yeah, I think that's a good way to look at it. I mean, obviously, when we reduced inventory originally in FY20, just volume itself going down is going to reduce, what's in work in process, what additional raw materials you're buying. So that's a bit of a, somewhat natural reduction with volumes overall going down. I think as we get into FY21, it shifts a little bit in that, the pace may not be quite as strong, and it'll shift a bit more to maybe the finished goods side of it, where we're reducing more out of the finished goods side rather than WIP and raw materials. But we're looking at really every pocket of inventory, looking for any kind of stranded inventory, you might say, in work in process, and trying to clean it up as best we can. We have an inventory steering committee that studies this quite heavily, and we report to senior staff, inventory levels at least weekly, if not more often than that. So it's a big push for FY21. We're confident we can continue to reduce inventory. As I mentioned in my prepared remarks, our inventory level as compared to sales is still quite high. Our turns, could certainly go up. So I think we still have a lot of room to improve, and that'll generate cash.
Got it. That makes sense. And then on the 737 MAX, given the recent news that we've heard there, I know that's about 8% of normalized volumes for you. How is the supply chain gearing up for the return to service? I know you mentioned the LEAP engines, but any other color you could add there on the MAX?
I think when you look at best estimates out there for MAX production in 2021, actual planes built, it's only probably 120 planes to be built. So I still believe there's significant inventory out there. Obviously, we went from the high levels in the 50s down to 0, and now probably plus or minus at the current time 4 a month. So there is still significant inventory out there. So I think a return and a bounce back in demand will be very gradual. We're looking, hopefully, at 31 a month starting in 2022, and as they begin to need material for that is when I think we'll begin to see a pull.
And then just lastly for me, you mentioned the new IGT customer. Anything you can tell us in terms of the magnitude, how we should think about that customer, and then your expectations for more share gains in the near term? Thanks.
Sure. I don't think I want to get into the actual volume for us in a company that only shipped 2.9 million pounds last quarter. It is certainly significant volume. It's a key piece in our puzzle. It's something we targeted and went after, and we feel real good about that. By the way, on IGT, the other thing that we really like about this market is we're finally seeing the supply chain at steady state. So instead of talking about all the inventory in the IGT supply chain, which we've been talking about forever, there's no more inventory reduction. When there's demand, we're seeing a pull for it. So we feel good about that in general and what's happening with that specific customer. And for us, it is significant. As far as other share gain, I believe the value that we provide with our service centers, with our just-in-time inventory, with our technical service, with our alloy development, I think there's opportunities everywhere in which we can find ways to outservice others out there, and that's what we're focused on doing. This is the one that has happened, so it's good to talk about, but we're certainly focused on others, whether it's here, aerospace, other areas.
Got it. Thank you.
Thanks, Mike.
And gentlemen, we do have a follow-up coming in from Chris Olin, once again at Tier 4.
Hey, sorry, I had a couple more. I thought I'd just knock those out here. Wanted to ask about Arcadia for two reasons. One, I know there's been a little bit of disruption in the titanium supply situation. I was wondering
Oh, Chris, we may have lost you.
We lost you, Chris. We can't hear Chris.
Mr. Olin, are you reconnected, sir?
Hello?
Gentlemen, I
Yeah,
believe
Chris,
I did that on my end. I
lost
do
you.
apologize.
Okay, to be clear, I'm online, right?
Yes, you are. We hear you.
Okay. Yeah, I'm not sure where I got knocked out there. I wanted to ask about Arcadia. There had been some changes in the titanium supply situation here over the past few months. I was wondering if that was an issue for that business on the quarter, as well as the issue with COVID and kind of Louisiana getting hit. Just kind of, if you maybe can give me an update there.
Sure. As far as the starting stock for Arcadia for titanium tube supply, not an issue at all. It's a very controlled process in which if processes change incoming, we are deeply involved, and our end-use customer is deeply involved with that. So we don't see anything there. It'll be a very controlled changeover. Our people and our supplier are all over that one, so no issue at all. COVID, significant issue, Chris, not only in Arcadia, but in all our facilities. You know, we're doing everything we can, social distancing, staggered shifts, ending shifts early, whatever we need to do to try to protect our people, but it's very difficult. So yes, we have significant issues in Arcadia. Our team is doing a great job of keeping things going, and I could say that about every facility we have. Our offices, the plant in Kokomo going through similar items. You know, it's not just what happens in the plant, obviously. It's what happens when people go out in the public or with families. We're all worried about what happens over Thanksgiving, but so far, our team's done one heck of a job in keeping things going while working to protect all our employees.
Okay. And Dan, you mentioned the COVID-related costs. Does that continue into the next year? Did you mention that?
Yeah, I think those would. I said $250,000 to $300,000. That's related to staggered shifts and, you know, teams cleaning different areas, as Mike was just kind of referencing there. I think that cost would continue as we continue to try to keep everyone safe and keep everyone separated. And, you know, anything we can do to help and protect their health, we're trying to do. So that'll have a cost to it, but pretty manageable.
And then the last question I had was, I thought I recalled GE talking about increasing production of the turbines, or maybe the outlook getting less negative. Has that helped your business yet? Or are you thinking about that market any different at all?
On power generation, I'd say on the mid and small size turbines, as Dan said in his prepared remarks, a lot of that's going into oil and gas, so that's certainly down. We finally see nice projections for the large frame engines, and our alloy content in those is good and continues to grow, especially on the proprietary side, so that's good. So we will see that coming, and as I noted, I think in one of my responses along here, we no longer see a supply chain full of inventory there. So when they start to build, we will feel it. Has it come yet? Not necessarily, but we do believe it will come, not certainly in huge quantities, not to where it was when we peaked in this market many years ago, but it certainly will begin to improve.
Thanks again.
Thank you, Chris.
And ladies and gentlemen, that does conclude our Q&A session for today's conference. I'm happy to turn the floor back to Mr. Mike Shore for any additional or closing remarks.
Okay, thanks everybody. We appreciate everyone's time. Thank you for your interest and support. Please be safe. Our thoughts are with you and your family in this incredibly unusual time we live in. Look forward to talking to you again next quarter. Thanks, everyone.